Good morning. My name is Scott Redler, Chief Strategic Officer of T3Live.com. Welcome to today's morning call. It is Wednesday, and you basically have massive red arrows around the world, where you have the bear markets deepening, you have downtrends extending, and we've been in a broken tape for quite some time. And recently, over the course of the past week, we've been talking about the actual structural damage, as most major markets and major sectors are all below their 8, their 21, their 50, their 100, their 200-day moving averages. That means you have risk reduced. You have hopefully lots of cash in most of your any time frame accounts. All depends on how you handle it. And if you're trading, you're taking caution. Now, on a micro level, before actually I get into that, I always talk about what's going around in the world. Europe down another 2% or so. Talked about the 9,300 in the DAX being a very crucial level for it to hold or break for more downside. That broke 2 days ago. You had a 1 day up yesterday. Now that's already taken back. You have Japan that's been slip sliding away ever since they said negative rates. And then you have had Asia closed for the holiday, and then the Hang Seng opens up and it's down, I think, almost 4%. So more headwinds. So those of us that trade actively every day, that try and hold swing positions, sometimes for 1 to 3 days, sometimes just trade intraday. If there's crazy volatility, we try and measure the action. And yesterday, to me, was one of those key days. We had one of those, push-through failure, red dog reversals into the 8-day moving average, which has rejected every rally attempt. And that's partially the reason why I'm short on the VTF, the spiders, and actually Apple, which I'll get into. So the question for today is, how do we handle the 2016 lows? That's the big, I think, theme. Everyone will talk about every theme out there, which is okay. But if you simplify it, 180, 102, and 1812 in the S&P is what we need to watch. Does the market hold a little bit above that and then rally, which it's already done twice this week, which I don't think happens again? Or do we get there, break below it, accelerate, waterfall, create panic, create fear, get down to some of the levels we talked about, 1770, 1780, and then, try and rebound off of that? Or do we push below it, no downside follow through, and come back above it? So 3 different types of questions to see how we handle today's action. Okay, so if you go to the chart here, you'll see this is the SPX. All right, this was, last year's lows. So the first time we got there, we pushed through it, and you did have your red dog reversal attempt here and your first attempted rally that failed into 1950-ish. Then he came back down. All right. Then it tried to stabilize. Then yesterday, to me, was a pretty key pivotal day, as you had this move. Remember, I talked about, I think we see 187 to 188 first. Well, that's exactly what took place. And the big thing was, would we get above this and squeeze? And then how would we handle the 8-day? Would we reclaim it or reject it? Thank goodness it actually closed on the lows and rejected it, because that's showing you another lower high, giving you micro technical weakness. Because if some guys like, were there any really clues that would be walking in with the the 30 handles down, besides the TLTs exploding and gold hanging up and banks went red? There were a lot of clues. But anyway, thank goodness for this. And this is partially the reason why I went short the spiders. And now we'll see what happens here. This is your 2016 low. This is your 1812, which we're a little bit above. So I covered a little. I'll wait to see what happens here. If we break below, I might even add to it and have more, to see what kind of cascade we have. You have to go to the macro chart. Now, besides the micro, okay, which we all talk about, I've been posting this intermediate chart of the S&P, showing, the potential head and shoulders top pattern, after an enormous move that we've seen over the course of the past 7 years. Okay, we've had a 7-year bull market where the Fed has had a pace of purchase, making sure every pull-in was shallow and nobody got scared. Well, anyway, this was a double top we took out way back when, and now here is where we're hovering, at major support. And if you look at this and you take a snapshot of that, basically, on the weekly, we're coming into the 200-day. You have your left shoulder, your head, your right shoulder. Here's your 1812. I guess if you take a look underneath here, this, the 200-day right here is 1815. You have another moving average here at 1790, which would probably be the spot, where if we push through 1810, That would be hopefully the first capitulation type spot. And then this is, well, you have so many little points in here, so it's going to be, this is actually closer to 1707. This 1700 is the spot I went over on Bloomberg, saying I think we at least get here. This would be a 20% move off the highs. Not for the year, but off the highs. Long way till that. So there's lots of points of reference. Everyone's looking at different types of charts. All you know for today is this spot, which is 1812. A break and close below that, and we stay below it, then there's lots of air pockets and lots of spots along the way. And really the measured move from this, just a 2100-ish down to 1850-ish is, 250 points. 250 points, that takes you all the way down to, 1600, which is a little bit above this. So there's a lot of stuff going on in here. So that's why, I've been talking on a macro level. Don't put any money to work, long-term money, and wait. In January, I tried to give everyone a little clues of what I was doing. I put my wife in 50% cash in a 401k, thinking that, at least only because she works for a state institution, so she can't put every month. But anyway, put intermediate long-term money in cash, and people are like, oh, when are you going to put it back? When it looked like we were having these short-term bounces, I'm like, I'm waiting till at least below 1770. So that's what I'm thinking there. But back to the active portion of the market. Okay, so most sectors have all been broken. They all have these, pivots to use today. Recently we've had some clues that that we're going lower from the banks. The banks have been really weak. Before that, the bios broke lower. You had, the Russell, no strength with structural damage. And then oil yesterday closing the dead lows, where the market tried to decouple from that for a little bit, but couldn't. So let's go to just some of these first. Let's go to the IBB. IBB, wow, look at the size of this move and the size of the down move. So it's getting close. Let's go back to the dailies, because that's what you guys want to watch me for, and how to make money potentially today. Well, first, you look at the IBBs, and it's been bad. Or look how it broke the 200-day there. Anytime a sector is below the 200-day, it's not a hold. It's not an investment. And it's only a swing trade long when it's above the 8 and the 21-day. But anyway, here is your recent low in the IBBs. It's all, how does it handle 240? Okay, came back, and what did it do? It got rejected by the 8-day yesterday. Some of you might have shorted into that if you played it for a bounce. Some might have just sold it. Well, anyway, here is your low. Write this down, 240.03. That is the IBB pivot. Let's just write down pivots. You have to simplify it and have it in front of you. You have the IWM also. You had this bear flag here. What a quinky dink, and broke the 200-day there. Here was your rally. Oh, another quinky dink into the 8-day. That's the trend. And here is your recent low. So write this down, 94.94. If it gets below that and stays below that, you do not buy the IWM. You could see lower prices. You want to go start looking at lower prices and where it can go. Really, this double top and this breakout here in the IWM, which eventually is where it might be able to go this year, is all the way down at 87-ish. But I don't think it gets there today. I think in my morning note I wrote about like 91. There's like 91.43 or something right around there. But look how this, look how these things work. Look at this head and shoulders pattern right here, with your left shoulder, your head, your right shoulder, neckline, almost near that measured move. The measured move from 130 through the neckline. Some said it was, just say even 110. That's 20 points. So 20 points from 110 takes you down to this 90 area. So we're getting closer, XLF, battered and bruised. On Bloomberg, I talked about it probably getting to 1850-ish. Let's just go to the daily again. Again, we want to look at these dailies. And another little quinky dink below the 200-day means you don't own the banks. Okay, and then this is the low. All right, here is your low. This is 2002. See how it handles that. And then I think underneath there's a small level around 1940-ish. And then I went over 1850. I'm not going to get into that. So, in all the sectors, you just want to write down those lows and simplify it. Below the 2016 low, it's not a long. If it accelerates down and you feel like, there was fear and capitulation, you want to buy versus a spike low level, you could do that. Then if it happens to retake that low, maybe you get some kind of reversal, that red dog reversal. But, a lot of day before any of that happens. You look at the USO yesterday. The USO, gave you some clues. It closed near the lows of the year, and it's opening below it. So I guess see what happens here. See if this gets reclaimed today. If not, it could see lower prices. This is 789. Go to the XLE. The XLE is showing some relative strength, maybe a false sense of security. Who knows? But Here, you want to see where this pivot low is, where there's a lot of room. This pivot low right here is 49.93. Write that down. You guys should all be watching, this morning call with your pen and paper, especially if you don't aren't a member of the Roll Access. What I do from 4:45 till I get in here is I write a note as real time as possible with levels, 1 or 2 pager. You can print it out, you can have it in front of you, and gives you my thoughts on all of these in a different fashion as well. So that's that. Now, those are the sectors. Now, as far as the stocks, I'm gonna be looking at high beta tech. High beta tech has been broken. They lost momentum. They've been just two-way action, range vehicles, and you had your 3-day bounce that failed yesterday. So today could be tricky there because all of them are pretty far off those lows from Friday or Monday morning. So if you start too early there, thinking that you could buy the down open for it to go green fast, kind of like it did yesterday or the day before yesterday, I'm sorry, just be a little bit careful. Let's go first with Amazon because they announced a $5 billion buyback. Yesterday Amazon was trading before I left around $4.97. Now it's down $6, $7 with the futures. So maybe see if Amazon can go green first. This has been battered and bruised. It lost a 200-day. Here's your lower pivot. Here is yesterday's low. So these are your two spots. Yesterday's low is 486. That's what it's above now. Maybe buy versus 486, and maybe they press the buyback button today. Who knows? But that's one spot, and then you have the low here of 474. So if it can't hold this or this with that announcement, you just know how weak we are. Google might not be as good to go to because, first of all, obviously, Google's been broken. Google's been broken since it couldn't hold 800 after earnings. Then you had your first attempt at the 200-day to hold. You had your 3-day bounce, and it failed right into the 8-day. What a quinky dink. So with no new news on Google, there might not be as much buy pressure. So, if you're looking between the two thin, high price stocks to trade, I would maybe trade, even though Google's a little bit more structurally constructive, which it's not that much, a little bit better. So here's your low here in Google, 682, and then you have the 200-day right below that. Netflix gave you a nice little snapback that failed yesterday. You look for, these broken names, that have come, crashing down. You don't want to overstay your welcome. And yesterday, it rallied up, closed near the lows after 3 days. That's a sell signal. So now I guess, see if it holds a little bit higher and shows some kind of constructive nature with market making lows and Netflix not making lows. Maybe it's building a better base for weeks from now. Who knows? But I would just write this down. Write down, 79.95. And if it's really that good, it probably holds somewhere around this 85 in the middle of it. You could probably use fibs for that, which I'm not going to get into. Okay, then I think another big clue or good thing to watch today is Apple. Everyone's like, Redler, you're short Apple overnight. Your first time I've ever seen you short Apple in a while. Well, look at the pattern here. It was relatively weaker yesterday. All in all, still contained by the 8-day. It's a stone throw away from this 92. Okay, 92. It hasn't broken this flash crash low yet, which a lot of stocks have. And it's just hovering. So I figured it was a safe bet if we're going to open lower to be short Apple. So now we'll see what happens here. I covered half below 93. You know what? If it doesn't show any kind of strength and doesn't kind of try and reverse, I might add to it below 92 because you go to your macro pattern here in Apple, and we've talked about this many times, and there are guys who are really calling for this to get into the 80s, to come somewhere around here. And if you look at the macro head and shoulders top pattern, you have your left shoulder, your head, your right shoulder. Oh, look when it broke the 200-day when Red Dog says you should get out of investments. That was right around 120 before breaking below this, accelerated trend. You might want to take a snapshot of that. Let's see. Here's a point of reference right here. This is also 88-ish. But all in all, could be a bear flag just to continue lower, kind of like you saw here too. But once again, Apple is very, very broken, below every moving average, trending below the AIM-21 day. Not healthy. So I guess if you want to look at the banks, Goldman Sachs has been leading the market lower. So with JP Morgan and Bank, well, they're all going. They all actually opened up yesterday with Deutsche Bank, closed near lows. Is that a buy signal or a sell signal? That's a sell signal. Okay, now today they're opening lower, through these lows here. Look at that, what a broken name. Look when this broke the 200-day. These are all rules you need to write down for the future. If you didn't, react fast enough, maybe you didn't make enough money on the downside short, but at least you shouldn't have been, holding your nose going down the whole way. It broke the 200, and this has been below the 8 and 21 day, pretty much the entire trend. And now it's opening below, this recent pivot. This pivot here is 145.10. See if it stays below that or not. On Bloomberg, I talked about, I think before, all said and done this year, that, Goldman and people were kind of yelling at me, which, okay, you could yell at me. I've thought somewhere around here will probably wind up being the lows of Goldman. It's already through this price point too. Thank goodness it had this head and shoulders top pattern to say, something's going on here in the banks. You probably don't want to be long besides it breaking every moving average, and this is when the neckline got broke around here. So if you go from 220 to 170, that's 50 points. 50 points from 170 takes you down to that level, which is 120. But these things take time. As of right now, just use the pivot that I gave you before. Then you have the metals, which has been the safe haven for guys who have been trading. That's created a new trend this year. This is probably one of the only sectors above the 8 and the 21 day besides the TLT, which shows you how weak the landscape is. And let's go to the GLDs first here, okay, to show you why momentum moving averages are so key, at least in my world. Look when the GLDs took back the 8-day right here, okay, and the GLDs have been above the 8-day moving average since about 104. And then this was your pivot. Really, that's when I think traders started getting more involved and believing in it. When it went above 106, came back, tested it, and wow. Okay, down here was a little wishy-washy. It gave you some signals, but here was when I think guys started to really look at it, and then it took back the 200-day, and yesterday it gave you a red dog reversal into the gap to close strong, and now it's up again. So we'll see. Where is there resistance? I think there is some resistance coming across here, a little bit closer to this 120 we talked about. So 120 is all the way up here, or actually this is like 108, 118-ish, and then you have all the way up here, which is 125. So if you're long it, congratulations. Into this big spike, I would definitely sell some. But anyone trying to be cute short for more than an hour or so is starting to probably feel it. So be careful there. And if you go to the TLTs, lastly, it too, to show you something stronger than weaker. This also is above. Look at that. Okay, look. First of all, look when this wedge got broken to the upside right there, and you want to look at strong things versus weak things above all moving averages. Well, TLTs have been above every moving average. Oh, look at Quinky Dick. It's been above the 8-day pretty much this entire year. You had a topping tail. Came into here, I remember talking about that, and then this we were like, you should cover shorts, maybe get along it. Well, anyway, another topping tail, held the 8-day, didn't fall apart, and now look, now it's opening up big. So with that being said, probably want to take some profits there too. Any big gap open that I'm involved in, I usually sell half and I try and hold half to see. So all in all, definitely signals out there to have risk down, to have to be careful, to play good defense like the Denver Broncos. I know it sounds sexy and great to be a good offense and sells tickets, but it could hurt you and whatever. I'm not going to go through that whole analogy. Anyway, at this point, if you're coming in flat, look at all those pivots you wrote down. The major one is the S&P at 1812. Do we hold above it and rally off it? Because then if you're shorts get a little scared, or do we get there, no real bounce, break below it and capitulate down through 1800 to 1770, 1780, 1790. You don't know. It's in fact, discovery phase. Do we break below it, get that fear, and then maybe the high beta tech names that are all above the earlier week lows don't make those lows and it comes back above it, then maybe you get a reversal pattern. But at this point, it all depends on your time frame on how you're handling this. If you're in a lot of cash because you went to a lot of cash considering that the sectors and the market dynamics were structurally somewhat broken to start the year and just got worse and worse, great. There'll be opportunities for you down the road. If you're trading actively, yesterday you could have been long in the morning and short in the afternoon. That's what you have to do. That's what you have to find, and that's what you have to discover as the trading, goes underway. And at this point, if you are short overnight, I'd probably cover half or 3/4, see the first half an hour, and then figure out if you could add back your shorts or if you need to cover and get some kind of long versus those levels. So that's that. See in a sea of red if anything goes green, to see if there's anything that could lead the market off these lows, or do we just have a trend down day that could really knock people's teeth out if they try and buy without a plan. Have a great day, good luck, and just be prepared and trade within your means. Don't try and be a hero today.